Exercise 5-21, we're going to journalize purchase transactions. So Kingston Tires uses a perpetual inventory system. The company received the following invoice from a supplier. The supplier is called Fields Distribution Incorporated. So we get this invoice, and then we had to figure out what's going on. Now, most accounting homework problems give you transactions like this. They just tell you exactly what's going on in a short sentence or two. But that's not the way real world accounting works. In the real world, you're going to get an invoice like this, and you have to figure out what's going on. So we are Kingston Tires, and our supplier is Fields Distribution Incorporated. So it looks like Fields Distribution is sending us an invoice for, and we can tell that this invoice was sold to us because it says sold to Kingston Tires. Payment terms 110 net 30. So we'll save 1% if we pay within 10 days. It looks like we bought some tires for a total of $929.6, and there's no shipping. I don't see any shipping costs. If there was shipping costs, it would just be part of the cost of inventory. So I'm going to position this a little differently. So down here I've got my T accounts. Here's the accounting equation, assets equals liabilities and owner's equity. We got merchandise inventory, increases on the left, decreases on the right. AP is a liability, increases on the right, decreases on the left. All right. So first transaction, requirement 1, journalize a transaction required by Kingston Tires on December 23rd. So we're Kingston Tires. This was sold to us. So we purchased inventory. So inventory is going to go up. Now later we will be needing to calculate the balance of our accounts. So that's why I've got these T accounts down here. So inventory is going up, and it goes up on the the left side. Merchandise inventory. How much did it go up? 929.60. Now notice it says do not round numbers to the nearest whole dollar. So we're trying to be realistic. If there's 60 cents, we're going to have to pay the 60 cents. Assume tires are purchased on account, record debits before credits, and select the explanation on the last line. All right, so we bought these on account. How can we tell that we bought these on account? Because it says payment terms. So AP is increasing also by 929.6, copy and paste. Our explanation is purchased inventory on account. Now, I'm also going to, because I need to figure out the balances, I'm going to, wonder if I can copy and paste that. Copy and paste that into my Excel down here. So basically I posted these to my T accounts, because on a piece of scratch paper you'll need to figure out what our balances are. Check our answer. All right. So then, requirement 2, journalize the return of on Kingston's books. So, and what did we return? The D39X4 radials. So these, the first line, the first set of tires, so this 152.48, I'm going to copy and paste that for my debit and credit. So we return these, so we do not owe this 152.48. So what's going to happen to AP? Down here, what's going to happen to AP when we return some of it? We're going to have to lower AP by 152.48. Okay, so AP, notice this is a debit, so AP is going to be debited. And then what happens to our inventory when we return inventory? Obviously it's going down. So I'm going to paste that. So inventory is going down. We need an explanation. Purchase, now returned inventory to the seller, also known as the vendor. All right. So now it says journalize the payment on October 1st. So what I recommend you do is start with AP. So what is the balance of AP? AP is 777.12. So when we pay this off, we have to get rid of all of that liability. How do we get rid of this liability? We're going to debit the liability. So 777.12. Wonder if I can copy and paste that. Hey, it worked. 777.12. So AP is going down. Oops, I should not put the credit there. All right. So let's figure out, do we get the discount? So according to the invoice, we bought it on September 23rd, and we can also see we bought it on September 23rd up here. But we're going to get 1% off if we pay within 10 days. So did we pay within 10 days? From the 23rd to October 1st, that is within 10 days. So we will get this 1% discount. So let's calculate the discount. So the discount is going to be based on the amount owed, 777.12, $777.12, times a whopping 0.01. So that's 0.01 is 1%. So we're going to save $7.77. So let me write this down so I don't forget. 7.77 is the discount. Okay, so how much will we pay? So the amount we pay is going to be 777.12 minus the discount. So we owe this, and we're saving this, so the difference is the amount we're going to pay. So 777.12 minus $7.77. So we're going to pay $769.35. So that's cash going down. Of course, cash is an asset, and assets go down on the right side. Now, this account or this transaction does not balance. The balancing amount happens to be the discount. So what account do we put this credit in? Well, this credit is going to inventory. So right here, I'm going to put 7.77 just to show you what's going on. So anytime we have a discount, anytime we pay early, we get a discount. It lowers the cost of inventory. Because how much did this inventory really cost us? It cost us $769.35. But watch what happens if I get rid of that discount. Watch what happens to this balance. If I get rid of that discount and put that to credit somewhere else, it's saying that the inventory would have cost us $777.12, but it's actually cost us $769.35. So how do we get it from $777.12 down to $769.35? We have to credit the inventory account. And now it's correct. The balance of inventory, in other words, the cost of inventory was $769.35. And the amount we paid was $769.35. Paid within the discount period. And just one final thing, remember the way you calculate, besides using a T account to calculate the cost of the inventory, another way to calculate the cost of inventory is take the purchase cost of the inventory, 929.6, minus any returns, here's return 152.48, minus the discount, which is right here, and then add any freight in, but we didn't have any freight in. So that's another way to calculate the cost of the inventory without using T accounts. T account actually does the same thing. But that's it.